Your second piece of property already carries a hidden government valuation, and the countdown has begun. Read this before you make another decision today. Not because it sounds sensational, not because it is attached to a fear-driven headline meant to provoke emotion, because at this very second, there is a federal legal system quietly operating against every real estate asset you own beyond your primary residence, and most retired property owners in America have absolutely no idea it exists. This is not a rumor. This is not an obscure legal argument. This is federal law written directly into statute, enforced by Medicaid agencies in every state, and it has been quietly dismantling middle-class family wealth for more than 40 years. Here is the reality. You spent 40, maybe even 50 years working. You paid down your main home. You followed the rules correctly, and somewhere during your lifetime you purchased another property. Maybe it was a lake cabin where your grandchildren spent summers learning to swim. Maybe it was a small mountain retreat where you dreamed of watching autumn leaves after retirement. Maybe it was a modest rental duplex that slowly became your most dependable source of income. You looked at that property and thought, this is our legacy. This is what stays in the family after we're gone. Federal Medicaid law looks at that exact same property and sees something very different. It sees a non-exempt countable asset with a market value that must be fully spent down before $1 of public long-term care assistance becomes available. The exemption amount for your vacation home, rental property, inherited acreage, or any secondary residence under Medicaid eligibility rules is exactly $0. Not $5,000, not $50,000. Zero. And if you transfer that property to your children without understanding the 60-month look-back penalty rules, you will not protect the property. Instead, you may trigger a penalty period where Medicaid refuses to pay anything, while nursing home invoices continue arriving at $12,000 every month. This is what the hospital social worker usually does not explain when she approaches your family in the hallway carrying a clipboard 2 days after your spouse is admitted. This is what many estate planning attorneys fail to fully explain when they hand you a polished binder and validate your parking ticket. This is what the Medicaid eligibility worker will not volunteer when she quietly slides a denial notice across the desk. Understanding this legal structure before a health emergency happens is not optional for retirees who own property in America today. It is the dividing line between preserving a family inheritance and being forced into liquidation at the worst possible time. The system begins with how federal law classifies real estate. Medicaid law creates one harsh and unmistakable dividing line across your assets. On one side is your primary residence, your main home, the property where you currently live and intend to return. Federal law protects that property during your lifetime through a home equity exemption ranging from roughly $730,000 in standard states to over $1 million in high-cost states, with annual inflation adjustments included. On the opposite side sits everything else. Every vacation home, every rental building, every piece of hunting land, every inherited parcel, every timeshare with equity, every shared ownership interest in property that is not your principal residence. The exemption for all assets in that category is $0. To the Medicaid eligibility process, your family cabin is not a treasured memory. It is not the place where generations gathered for decades. It is viewed as an unused bank account covered by walls and a roof. A non-exempt countable asset with fair market value that must be converted into cash and spent on care expenses before Medicaid covers even 1 day of skilled nursing facility costs. This classification is not random. It is written directly into federal law under 42 U.S.C. 1396P and has existed for decades. The information has always been publicly accessible. The problem is that very few people with financial incentives to educate you have ever explained it clearly. The primary residence exemption, the conditional protection. Most people misunderstand an important detail that makes the risk far worse for unprepared families. The primary residence exemption is not automatic. It is conditional. It depends entirely on a federal provision known as the intent to return home clause. When completing a Medicaid long-term care application, you must specifically declare, through a checkbox, written statement, or notarized affidavit depending on your state, that you intend to return to your primary residence. Once you check that box, the home becomes classified as a non-countable asset for eligibility purposes. Its equity remains protected during your lifetime. But the moment you fail to state that intent, or worse, when a relative tells the Medicaid worker that the patient is unlikely to return home because of severe medical condition, the full equity value of the house changes from exempt to countable almost instantly while the caseworker updates the file. That conversion can happen during a single office meeting. Families who attend Medicaid application appointments without understanding this rule often expose their primary residence equity because of one honest but legally disastrous statement about a loved one's health condition. There is no comparable protection for a second property. No declaration of intent protects it. No checkbox shields it. The zero exemption applies no matter what explanation you give. The 60-month look-back system. Why emergency transfers make things worse. When families first discover the non-exempt asset rule, their first instinct is usually to transfer the second property to children before applying for Medicaid. Sign over the deed, move the ownership, problem solved. That instinct makes emotional sense. Unfortunately, it is also one of the most financially dangerous decisions possible. When you apply for Medicaid long-term care coverage, you automatically activate the 60-month look-back period. Starting from your application date, the state has legal authority to inspect every financial record, every deed transfer, and every asset transaction going back exactly 5 years, transaction by transaction, day by day. If during that period you transferred the second property to your children for less than fair market value, the state categorizes that as an uncompensated transfer. The transfer is not reversed. Instead, the state calculates a penalty period. Here is how the formula works. The value of the uncompensated transfer is divided by the state's official average monthly nursing home cost. The result equals the number of months Medicaid refuses to contribute toward your care expenses. Let's walk through real numbers. A married couple owns a primary residence worth $400,000 and a mountain cabin worth $200,000. One spouse suddenly requires nursing home care costing $12,000 per month. 2 months before filing the Medicaid application, the healthy spouse transfers the cabin to their adult son for $1 listed consideration. The Medicaid worker finds the transfer using public deed records. The uncompensated transfer amount becomes $199,999, divided by the state's monthly penalty divisor of roughly $8,500. The result is a penalty period of approximately 23 months. For 23.5 months, Medicaid pays absolutely nothing. The family must privately cover $12,000 every month. Total private cost before benefits begin, approximately $282,000. The cabin is gone. The son legally owns it. The transfer cannot be undone. And now the family owes nearly $300,000 before Medicaid covers a single day of care. The emergency transfer did not preserve the inheritance. It transformed a $200,000 issue into a $282,000 financial disaster. The state-by-state reality. Your state determines your level of risk. Federal law establishes the framework. State laws determine how severe your specific exposure becomes. Florida provides strong constitutional homestead protections for primary residences against creditors during life and probate creditors after death. However, Florida Medicaid provides no protection for secondary real estate during eligibility reviews. A primary home in one county and a condo in another county. The primary home remains exempt under the intent to return rule. The condo is completely countable at market value and must be liquidated. Ohio follows the baseline federal home equity limit of around $730,000 for the 2025 to 2026 period with inflation adjustments each year. Ohio also operates one of the country's more aggressive Medicaid estate recovery systems. Secondary real estate owned at death after Medicaid long-term care assistance was received may be pursued through probate recovery claims by the state. California removed asset limits completely for its Medi-Cal long-term care program beginning in 2024, creating the broadest eligibility standards in America. However, California still maintained estate recovery rules for assets passing through probate after death. Secondary real estate that goes through probate after a Medicaid recipient dies may still face state recovery claims. The eligibility door became easier to enter, while the recovery system remained fully operational. Massachusetts runs one of the broadest estate recovery systems in the nation, pursuing not only probate property, but also some non-probate transfers, joint tenancy interests, and life estate remainders under expanded authority rules. Texas maintains a more limited estate recovery program focused mainly on probate assets, making careful probate avoidance planning especially useful for Texas families. 3 states. 3 entirely different legal environments. 1 identical outcome for families that fail to prepare early. The Medicaid Estate Recovery Program. The part most families never expect. Understanding eligibility rules is only half the issue. The second half begins after death. Federal law under 42 U.S.C. 1396p subsection B requires every state to operate a Medicaid estate recovery program. The rule is simple. When a Medicaid long-term care recipient dies, the state must attempt to recover the cost of benefits paid during that person's lifetime from the deceased individual's probate estate. Every dollar the government paid toward nursing facility care may be pursued against assets remaining in the recipient's name at death. Secondary real estate becomes an ideal recovery target. It is physical, easy to identify, simple to value, and commonly passes through probate when no planning exists. The state files a claim against the estate. The claim equals the full amount of Medicaid benefits paid. If benefits totaled $300,000 and the cabin is worth $200,000, the state claims the entire cabin. The children receive nothing. In states with broader recovery authority, recovery may extend beyond probate assets into jointly owned property, life estates, and certain trust assets depending on structure. Here is the critical point most families fail to understand. Qualifying for Medicaid during life does not automatically protect secondary property after death if you still legally own it. Estate recovery is a separate process activated after death through probate. The 3 legal strategies that genuinely work. This is the practical section. These are the real strategies attorneys use to protect secondary property before a medical crisis occurs. Strategy 1. The Medicaid Asset Protection Trust. A Medicaid Asset Protection Trust is an irrevocable trust prepared by a qualified elder law attorney into which ownership of the second property is transferred. After the transfer, you no longer legally own the property. The trust owns it. For Medicaid eligibility purposes, the asset no longer appears in your personal ownership. The 60-month look-back rule applies beginning on the transfer date. If the cabin enters the trust today, and you do not apply for Medicaid long-term care until at least 5 years later, the transfer falls entirely outside the look-back window. The state cannot count the property toward eligibility. The state cannot impose a penalty. Return to the same couple with proper planning in place. 6 years before the medical crisis, they meet with a qualified elder law attorney. They spend approximately $5,000 to $7,000 establishing and funding the trust. The cabin is transferred into the irrevocable trust with their adult children listed as remainder beneficiaries. The family continues using the cabin under carefully drafted occupancy language inside the trust document. They maintain the property and continue paying taxes. 6 years later, the medical crisis occurs. The Medicaid application is submitted. The caseworker reviews the records. The primary home is protected through the intent to return provision. The cabin is owned by an irrevocable trust established 6 years earlier, entirely outside the 5-year look-back period. Medicaid benefits are approved. Nursing home costs are covered. The primary residence remains protected during the healthy spouse's lifetime. The children inherit the cabin intact. A $5,000 legal expense protected $200,000 in family wealth. The financial return exceeds 4,000%. Strategy 2. Strategic sale with exempt asset repositioning. For families whose second property functions more as an investment than an irreplaceable family location, or whose property creates complications, making trust ownership impractical, a strategic sale may offer another path. The property is sold at fair market value in a legitimate arm's-length sale to an unrelated buyer. The proceeds are then moved into Medicaid-exempt assets. Purchasing a larger or more valuable primary residence with the proceeds is one acceptable strategy because primary residence equity remains exempt up to the federal limit. Prepaying funeral and burial costs through an irrevocable funeral trust is exempt in many states. Certain Medicaid-compliant immediate annuities structured according to federal safe harbor rules can convert countable assets into income streams that meet eligibility standards. The important requirement is timing. The sale must occur at least 60 months before any Medicaid application, and the proceeds must be managed under a strategy created with an experienced elder law attorney. Strategy 3. Long-term care insurance. For retirees in their early or middle 60s who remain healthy, a properly structured long-term care insurance policy or hybrid life insurance policy with long-term care riders can transfer the financial burden of nursing home costs away from your property portfolio and onto an insurance company. When long-term care becomes necessary, the insurance policy covers facility expenses. The second property remains untouched. Rental income continues flowing. The cabin passes intact to the next generation. This strategy requires planning roughly 10 to 15 years before likely need. Premiums can be expensive. Medical underwriting may disqualify applicants with certain health conditions. But for the correct person at the right age and financial situation, long-term care insurance can eliminate the secondary property problem almost entirely. The mistakes that destroy everything. Several approaches retirees attempt without professional legal guidance create outcomes worse than doing nothing at all. Giving property directly to children triggers the 60-month look-back penalty, while simultaneously exposing the property to your children's creditors, divorces, bankruptcies, and lawsuits. You surrender ownership while gaining no meaningful protection. Adding children onto the deed as joint tenants creates a partial gift, removes the stepped-up tax basis available at death under Internal Revenue Code Section 1014, and creates potential capital gains tax liability capable of destroying more value than Medicaid recovery would have taken. The tax damage alone may exceed the original issue. The late-night panic deed transfer done around a kitchen table immediately after a diagnosis without legal counsel and without understanding the look-back rules is one of the most financially destructive actions possible. The transfer is discovered. The penalty period is imposed. The property is gone. The nursing home invoices continue. The family suffers every consequence simultaneously. Your 90-day action plan. Within the next 30 days, contact a qualified elder law attorney licensed in your state. Specifically, choose an attorney focused on Medicaid planning, long-term care law, and asset protection. Not a general estate planning lawyer. A true specialist. Bring a complete inventory of every property you own, the approximate equity in each property, and recent financial statements. Ask direct questions about Medicaid asset protection trusts in your state's specific look-back rules, your state's estate recovery scope, and whether your state has expanded recovery authority beyond ordinary probate assets. Within 60 days, implement whatever strategy your attorney recommends. The 60-month clock begins running on the execution date. Every day of delay is one less day of protection once a medical crisis arrives. Within 90 days, confirm that every deed, trust document, and beneficiary designation has been correctly signed and properly recorded. An unrecorded deed protects nothing. An unfunded trust protects nothing. The final calculation. The average stay in a skilled nursing facility for long-term care in the United States is roughly 28 months. At $12,000 each month, that equals approximately $336,000. Half of all residents remain even longer. A $200,000 cabin pays for about 16 months of private nursing home care. A $400,000 rental property covers about 33 months. In the eyes of the Medicaid office, every dollar of equity in every secondary property you own represents a future payment toward nursing home expenses. The 5-year look-back clock already started today. Not on the diagnosis date, not on the Medicaid application date. Today. The families who successfully preserve their second properties are the ones who learned these rules 5 years before needing Medicaid, not 5 days afterward. The planning opportunity exists right now. It will not remain open forever. So contact a qualified elder law attorney in your state within the next 30 days. The price of that consultation may become the most financially valuable investment any property-owning retiree in America can make today. This material is educational and analytical only and should not be considered legal advice, financial advice, or Medicaid planning guidance for any individual case. Medicaid eligibility standards, exemption limits, look-back periods, and estate recovery policies differ substantially by state and may change through legislation or regulation. Speak with a licensed elder law attorney in your jurisdiction before making decisions regarding property transfers, trust creation, or Medicaid applications.